Welcome to Iron Financial. We're here to help you forge a stronger portfolio and, really cut through all the market weakness and the noise. Today, we're putting FB Financial Corp under the microscope. The ticker is FBK. They just dropped their Q1 2026 numbers, and we are going to tear them apart, piece by piece. We need to find out if this regional bank is a fortress built to last, or if it's just a facade, one that's waiting to crumble. Let's get to work.
Okay, let's dive right into this. The headline numbers, they look impressive. It's a classic earnings beat, the kind of thing that gets the trading algorithms all excited. But our job here isn't to follow the algorithms, it's to get ahead of them. So we're going to stress test this company's entire structure. I mean everything. We'll start from its very foundation, that's the balance sheet, and we're going to work our way all the way up to the armor that's supposed to protect it from the next downturn. We absolutely have to know if this strength is real or if it's just a fresh coat of paint. Whoa, hold on a second. Before we get lost in the weeds here, let's just set the stage for everyone. Because on the surface, you're right, things look good. I mean, the stock has had a fantastic 12-month run. It's up nearly 36%. Profits are up. But, and this is a big but, there are already whispers out there, red flags, if you actually know where to look. We're talking about a revenue miss. We're talking about insiders selling off their shares. And maybe most importantly, we're talking about third-party valuation models that are practically screaming that this thing is overvalued. So the question is pretty simple when you boil it down. Is this all just hype, or is it for real?
Exactly. And that's the conflict we're here to resolve today. So we've structured this entire analysis into 6 distinct sections to get to the absolute truth. First up, we're going to hit the headline numbers. That's the big earnings beat everyone's talking about. Then we'll move on to the real heavy lifting in forging the balance sheet. For Section 3, we're firing up the profitability engine to see just how efficiently this bank is actually making its money. Section 4 is absolutely crucial, testing the armor. That's where we'll examine credit quality and its capital strength. In Section 5, we're going to confront the valuation and those red flags head-on. And finally, in Section 6, we will deliver Iron Financial's verdict. No ambiguity, no hedging, just a clear, actionable conclusion.
All right, Section 1, the headline numbers. Now, this is what moves the market in the first 24 hours after a report drops. This is the story the company wants you to see. So let's look at it through their lens first, and then we'll start asking the hard questions. So this is the number that grabs all the headlines. $57.5 million in net income just for the first quarter of 2026. This is the core profit figure. It's a strong, solid number that right off the bat signals some serious operational strength. On its own, it tells you one thing pretty clearly. The company is making serious money.
But of course, a single number doesn't mean anything without context. And this is really where the story gets powerful. I mean, just look at that year-over-year growth. They went from $39.4 million in the first quarter of 2025 all the way to $57.5 million now. That is a massive 46% jump. That's not just growth, that's explosive growth. It tells a story of significant operational improvement and serious expansion over the last 12 months. And look, quarter over quarter, it's basically flat. It's stable. They're holding the huge gains they made at the end of last year, which is exactly what you want to see. This is, without a doubt, a powerful earnings beat.
And here's how that profit translates directly to the shareholders. Diluted earnings per share, or EPS, came in at $1.10. That's up 31% from the same quarter last year. But more importantly, the adjusted EPS, which is the number the analysts on Wall Street really focus on, came in at $1.12. The consensus estimate was $1.10, so they didn't just meet expectations, they beat them by 2 cents. And let me tell you, in the banking world where every single penny is scrutinized, that is a solid, undeniable win.
Okay, profits are up. I get it. But let's not get carried away here. An earnings beat is great, but it's only one piece of the puzzle. The real question is, how did they get there? Did they actually grow the top line, or did they just slash a bunch of costs to make the number look good? Because the data shows their revenue came in at $172.34 million. The consensus estimate, $175.42 million. That's a miss. So while the profits look good, the actual sales, the top-line revenue, fell short of what the street was expecting. Is the engine sputtering? Are they struggling to bring in new business at the rate everyone predicted? To me, that sounds like the first crack.
Yeah, that's a fair challenge. And it's the perfect transition to our second section here, forging the balance sheet. Revenue is one thing, I'll give you that. But for a bank, the balance sheet is absolutely everything. It is the foundational structure. Think of it like the steel frame that supports the entire operation. So let's see if the heavy lifting they've been doing here backs up those profit numbers, or if it reveals even more weaknesses.
Just look at these numbers. This is the heavy lifting I'm talking about.
total assets are up almost 26% year over year, from $13.1 billion to $16.5 billion. That is massive expansion. But more importantly, look at the core of their business. Loans held for investment are up nearly 28%, and total deposits are up almost 26%. This is not some financial engineering trick. This is a bank that is aggressively expanding its core operations, taking in more money from depositors and lending more money out to customers. This is fundamental, powerful growth that directly fuels the bottom line. I see the growth. I do. But I also see risk. I mean, growing your loan book by nearly 28% in a single year, that is incredibly aggressive. Are they maintaining their lending standards, or are they just chasing growth by taking on riskier and riskier borrowers? Is this sustainable, well-managed growth, or are they just growing way too fast? I mean, history is just littered with banks that expanded recklessly right before a big downturn. How do we know this isn't the exact same story playing out again?
That is absolutely the right question to be asking. And the answer to that question lies in one word: discipline. This slide here shows the loans-to-deposit ratio. It is a key metric for measuring a bank's liquidity and really how it's managing its own growth. It sits at 88.8%. A year ago, it was at 87.2%. The quarter before this one, it was 89%. So what does this tell us? It tells us that despite that massive 28% growth in lending, their loan book is still very comfortably supported by their deposit base. They aren't over-leveraging themselves. They're growing loans and deposits in lockstep. This isn't reckless expansion. This is disciplined, methodical growth. They are forging a larger, but still very solid foundation.
Okay, so the foundation is bigger and it appears to be stable, so now let's move up the structure a bit, into the engine room. Section 3, the profitability engine. This is where we look at how efficiently the bank is converting that massive balance sheet into actual, tangible profit. A bigger balance sheet is totally useless if your engine is inefficient and, leaking oil all over the place. So is this machine firing on all cylinders, or are there signs of trouble under the hood?
This table tells a really compelling story. First, just look at the net interest margin, or NIM as we call it. Year over year, it's expanded significantly, from 3.55% to 3.94%. That means they're earning much more on their assets compared to what they're paying out on their liabilities. That is a huge driver of profitability. But the real star here, in my opinion, is the adjusted efficiency ratio. It has improved from nearly 60% a year ago all the way down to 54.3% today. In banking, a lower efficiency ratio is better. It means it's costing them less and less to generate $1 of revenue. This is the sign of a well-oiled machine that is becoming more profitable as it scales up. Wait a minute. You can't just brush past that NIM number like that. Yes, it's up year over year, but look at the quarter-over-quarter trend. It dropped. It went from 3.98% in Q4 down to 3.94% in Q1. Now, that's not a huge drop, I'll grant you, but it's a reversal. The company itself said this was because of lower yields following the Fed's rate cuts late last year. So my question is this the beginning of margin compression? Is the profitability engine, which was running so hot, starting to cool down under pressure from a changing interest rate environment? You're right to point that out. That's a sharp observation. Rate pressure is real and it affects the entire banking sector. But this is exactly where good management separates itself from the rest of the pack. So the crucial point is to look at the other side of the equation. Look at the last line on that table. Cost of total deposits. It's decreasing. It went from 2.54% a year ago to 2.40% last quarter, and now it's down to 2.27%. So while the rates they're earning on assets are facing some pressure, they are actively and successfully lowering what they have to pay for their funding. This is what disciplined liability management looks like. They're cushioning the impact of those rate cuts and defending their profitability. The engine isn't weakening, it's just adjusting to new conditions.
And that defensive profitability leads us directly into our next section. Section 4, testing the armor. A bank can have a great balance sheet and a powerful engine, but it's all worth nothing if it doesn't have any armor. We're talking about the capital reserves and the credit quality that protect it from unexpected economic shocks. This is what separates the banks that survive a recession from the ones that don't make it.
And the first and most important piece of that armor is a number that sounds kind of technical, but trust me, it is everything in this business: 11.5%. This is their preliminary Common Equity Tier 1 ratio, or CET1. This is the ultimate measure of a bank's ability to absorb losses, and it represents the absolute highest quality capital a bank can have. A higher number means a stronger fortress. Simple as that.
Hold on. Just stop right there. You're throwing around terms like CET1 and risk-weighted assets. You've got to translate that from banker speak for us. I'm representing the audience here, and we need to know, in plain, simple English, what this number actually means.
Why is this the first line of defense? What is it even defending against?
That's a fair point. Let's make this really simple. Think of the CET1 ratio as a household's emergency fund. It's not your checking account. It's the high-quality, easily accessible cash you have set aside to cover unexpected disasters. You know, a job loss, a medical emergency, something like that. For a bank, those disasters are unexpected loan losses. The CET1 is its core capital, its common stock and retained earnings that acts as the primary financial cushion. Now, regulators require banks to hold a certain amount, but a higher ratio, like FBK's 11.5%, means they have a much bigger emergency fund than they are required to have. It means they can withstand a significant economic storm without breaking. It truly is the ultimate measure of resilience.
Okay, that makes sense. The emergency fund is large. Got it. But are they having to dip into it more often? Let's talk about the actual credit quality, because the data shows what looks like a potential crack in the armor. Look at non-performing loans as a percentage of total loans. A year ago, it was 0.79%. Today, it's 0.96%. That's a noticeable uptick. And it's the same story for non-performing assets, which are up from 0.84% to 0.98%. Are we starting to see the consequences of that rapid loan growth we talked about earlier? Are more of their borrowers starting to struggle? I don't know. This looks like a sign of stress to me. It is an increase, and it absolutely warrants monitoring. You never, ever want to see those numbers go up. But context here is critical. An increase from a very low base is not the same thing as a dangerous spike. So the crucial point is to look at the actual realized losses. The annualized net charge-off rate, these are the loans they actually had to write off as a complete loss, was just 0.11%. That is an exceptionally low number. So while more loans are being flagged as troubled, the bank is proving to be extremely effective at managing those situations and avoiding actual losses. So yeah, the armor might have a little scuff mark on it, but it has not been breached.
That brings us to the external view. Section 5, Valuation and Red Flags. Look, so far the internal picture looks mostly solid. We've got strong growth, improving efficiency, solid capital. But the market doesn't just look at the internals, right? It looks at price, at sentiment, and at what the so-called smart money is doing. And this is where the bear case really starts to get some teeth. This is where we have to ask ourselves, is this a great company that's just selling at a bad price?
Let's just start with a direct quote from a respected third-party analysis, Guru Focus. Their conclusion is blunt. They say, based on our proprietary GF value, FB Financial appears overvalued. They pegged the fair value of the stock at $50.75. The stock is currently trading around $55. That's nearly a 10% premium to what their model says this company is actually worth. Now look, this isn't our opinion. This is an independent valuation model that is strongly suggesting that the market has gotten way ahead of itself here.
And this slide right here lays out the full bear case. It's not just one thing, it's a collection of pretty serious warning signs. You've got the overvaluation that we just mentioned. Then you have the insider activity. In the last 3 months, insiders have sold $500,000 worth of stock. And how much have they bought? Zero. A big fat nothing. The people who know the company best are selling, not buying. On top of all that, Guru Focus gives the company a growth score of 1 out of 10. 1. That is an abysmal score suggesting that future growth prospects are extremely weak. And it all ties back to what we said at the very start. They missed their Q1 revenue estimates. These are not minor issues. These are significant red flags that you just can't ignore.
Those are all valid external metrics, I agree, but they clash directly with what management is actually doing with the company's capital. And in my book, actions speak louder than models. So let's look at management's actions this quarter. First, the company itself repurchased over 426,000 of its own shares. That is a direct statement from the board that they believe their stock is undervalued, not overvalued. Second, they increased the quarterly dividend by a whopping 11%. You do not do that if you are worried about future growth. And third, this was their 32nd consecutive dividend payment. This is not a company that's worried. This is a management team that is so confident in their operational strength and their future prospects that they are aggressively returning capital to shareholders through both buybacks and dividends. That right there is the ultimate signal of internal confidence.
And this brings us to the final showdown. It's the internal strength versus the external warnings, the fortress versus the facade. We are now going to synthesize all of these conflicting data points into a clear, actionable conclusion as we deliver Iron Financial's verdict.
All right, let's lay it all out side by side. The bull case, the argument for the fortress, is built on hard internal performance metrics. You've got that powerful 46% year-over-year earnings growth. You have the massive, yet very disciplined 25% plus expansion of the balance sheet. You have a profitability engine that is just getting more efficient every single quarter.
You have rock-solid capital armor with a high CET1 ratio. And you have a management team that is screaming confidence with aggressive buybacks and dividend hikes. The foundation is strong, the engine is running well, the armor is holding. But the bear case, the cracks in the facade, is built on equally valid external metrics and forward-looking concerns. The revenue miss is a fact. The guru-focused valuation model flags it as overvalued. The insiders are selling, not buying. That growth store is a dismal 1 out of 10, and there's that undeniable, albeit slight, uptick in non-performing loans that you have to watch. The risks here are very clear.
So, what is our final verdict? After weighing all of this evidence, Iron Financial concludes that FBK is a solid but fully valued fortress. The company's fundamentals are undeniably strong. The management team is executing incredibly well. This is not a facade. The fortress is real, and it is well built. However, the market already knows this. The stock's current price appears to have priced in all of that good news and all of that operational excellence. There is very little margin of safety at these levels. For current shareholders who bought in lower, this is a solid hold. But for new buyers who are chasing the momentum, this could be a potential trap. You are paying a premium for a high-quality asset, and that leaves absolutely no room for error or any future stumbles. And that leads us to the final question that you really need to ask yourself. With the stock already trading at a premium, with these external valuation models flashing warning signs, and with a pretty pathetic growth score, what is the next catalyst? If the market is already priced in all this good news, what could possibly happen to drive this stock significantly higher from where it is today? That's the question that should keep you up at night. That is the bar this company now has to clear.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.